Assalamu alaikum to all of you and a very good morning. Can you hear my voice clearly? If yes, please write yes in the chat box so that we can start the session. Okay. So, did you attempt the homework? What about the home assignments? Any updates about the home assignments? Have you done this? The question shown on the screen. This is one of the questions that I have given to you yesterday. Hello, can you hear my voice? Yesterday we were talking about topics related to the cash flow. This was the format for the operating activity. And I gave you guys this question to attempt at home. Quickly, you just give your feedback about this example. Have you guys attempted this or not? I'm not getting any messages from the students. I don't know why. Please write something in the chat box so that no. Okay. Okay. Let's start with this question. I'm giving you this question and I'm giving you 5 minutes. In fact, 1 minute to solve this question. So this is the format. We always start with the profit before tax. Then depreciation. The profit before tax in this question is 3975 minus 450. 3975 minus 450. 3525. So here we have the profit before tax. Then the second thing is depreciation. You can see here the depreciation is 1875. So I'm going to add 1875 here. The next thing is the profit and loss and disposal. The profit and disposal is 225 here. So it should be deducted. The finance cost is 450. So we add it here. There is no interest receivable in this question. So, or any other income. So we are going to ignore this value. Can we calculate the final figure? Which you should report on the right hand side. That is 1875 minus 225 plus 450. The amount will be 2100. Now, in case of inventories, there is a reduction in the inventory by 600. Then there is an increase in inventory by 1350. Increase in receivables should be deducted. Deduction should be added. The next thing that we have is increase in payables. Payables will be increased by 750. Increase in payables will be added here. So the final amount is 600 minus 1350 plus 750. So net impact will be 0. So the cash flow from the operations will be 3525 plus 2100. The amount will be 5625. Then in this question, there is no concept of interest paid, but there is a taxation paid of 900. So the final answer will be 4725. Very good. I request all of you to do participation in these questions because it is very important with respect to the examination. So you have to be quick and do as maximum participation as you can. Is it clear to all of you? Only one yes has received it. Why should we minus 450 from the PBI? Actually, we have been given profit before interest and tax. And according to IS 7, we always start the cash flow from the profit before tax. So we have been given profit before interest and tax. When we deduct interest, finance cost from the PBIT, we got the value of profit before tax. And then when we deduct the taxation, we got the value of profit after tax. So in this question, the examiner didn't give us the value of the profit before tax. That's why we have to deduct interest from the PBIT in order to calculate the profit before tax. So is it clear? Any other confusions? One of the students said there is was the finance cost. Why didn't you deduct that? No, we didn't add the PBIT. First, you need to calculate the PBT. So, should we move forward? We should minus it again. Then we should add back it again over the period. First, you need to calculate the profit before tax, and after that, you have to add back the figure. You can see here that I have added back the value of 450 for cash flow purpose. So if you guys want to ask anything, please do ask immediately. Otherwise, we will be moving towards the next question. Abdul Wahab and Yusra Mahmood. There are two students. Are you guys satisfied, or you need some more explanation? Okay. So moving on. Now we have got this format. Now you always start with operating activity. Sorry. You always start with operating activity and with the profit before tax. Then we add back the depreciation or amortization. Profit or loss of disposal should be adjusted. Investment income should be deducted. Interest expense added back. Increase in inventory less. Increase in receivable less. Increase in payable should be added here. It's not deducted. Then we got the value of cash generated from operations. Then we deduct the interest and tax. We got the value of net cash from the operating. Sometimes examiner might give you the value of net cash from the operating activity, or they might ask to calculate the cash flow from operation. So how we can calculate the cash flow from operation from the net cash from the operating activity? Any responses? How we can calculate the cash flow from operations from the net cash from the operating activity? Yes, very good. We need to add back the interest and the taxation figure in order to calculate the cash flow from operations. Then moving on towards the investing activity. Purchase of non-current assets is a cash outflow. Sale of non-current assets is a cash inflow. Dividend received, interest received. Then we got the value of net cash flow from the investing activity. We're talking about the financing activity, issue of shares, borrowings, dividend paid, and net cash flow from the financing activity. So by adding operating activity plus investing activity plus the financing activity, you got the value of net increase or decrease in cash flow. So sometimes the examiner might ask you to calculate the reverse working. So see this equation: operating activity total plus investing activity total plus financing activity total is equals to net cash flow, increase or decrease. The examiner might give you this value, and this value, and you are required to calculate the missing figure, which is net cash flow from the investing activity. Or sometimes it might be the net cash flow from the financing activity. So out of these four values, one item will be missing, and you all are required to calculate the missing figure. Then cash and cash equivalent at the start should be added in the net change. So it should reconcile with the closing balance. So if it is reconciled with the closing balance, that it means your cash flow is perfect. Otherwise, if it is not get balanced, then it means that you have done some mistake in the calculations. Is it clear? Okay, wonderful. Okay, so let's move on towards some practice questions. Now, please do attempt these three questions: 59, 60, and 61. You have 2 minutes to solve it. Yes, I'm waiting for the answers. Please give your answers. Very good. One of the student has done 59, 60, and 61. I'm waiting for the answers from other students. In relation to the statement of the cash flows, which if any of the following statements are correct? We're going to attempt the first one right now. The direct method of calculating a net cash flow from the operating leads to different figure from that produced by the indirect method. Now, this is the point. This is the point that we have discussed already in the last class, that the direct and the indirect method will give you the same answer. So this is wrong. So technically, if you see the statements, if statement 1 is wrong, then you have to identify which one is right. Entity making higher profits must necessarily have a net cash flow from the operating activity. Wrong, because you can earn a profit even on the credit sales. Profits and losses on the disposal of non-current asset appear as item under the cash flow from the investing activity. The profit and losses are covered as an adjustment in the indirect method of operating activity. So the right answer is D. For the first one. Now, what about the question number 60 and 61? Question number 60 and 61. Okay. For question number 60, we have been given a profit of 63,400 before tax after charging a depreciation. And you are required to calculate what was the net increase in the cash balance during the year. So if the question says you about the net increase in the cash balance, that it means that they are asking for the overall answer for the operating, investing, and financing activity. So let's do the calculation for this one. Right now the question says the profit before tax is 63,400. You have to add back the depreciation figure, which is 2,700. Then in decrease in receivables should be added 600. Increase in inventories should be subtracted from here. Increase in the trade payable should be added Non-current assets purchase should be deducted from here, and loss on disposal should be added. So when you do these calculations, you got the value 63,400 plus 2,700 plus 600 minus 2,500 plus 900 plus 1,700, 1,300 plus 3,000. So the right answer is C. Is it clear to all of you? Loss and disposal should be added back. Is it clear to all of you? 60, question number 60. Now what about question number 61? Which of the following is not shown in the statement of cash flows? Investing activities, financing activities, cash flow from the profits of the business. C will be the answer for this question. So this is again a very easy and simple question. So now I'm giving you just question number 63 with the name logic. I think there's a mistake in this question. It should be financing activities. Financing. Please do calculate this question. So the right answer will be B. So how I have solved this question? Loan redeemed. Loan redeemed means that we have repaid the loan amount. So it's a negative cash flow. Dividend paid will be cash outflow. An increase in the share capital means there is a cash inflow. That answer will be 212,000 negative. And as we all know that bonus issue is a non-cash activity. Okay, let's start this question. Are we supposed to add bonus issue in the indirect manner? No. We always ignore the bonus issue in the cash flow statement, whether it is a direct method or indirect method. An indirect method or direct method is only concerned with the operating activity. It has nothing to do with the financing activity. So there are two methods available in the operating activity only. But in case of investing and financing, there is only one method. So there is no concept of direct and indirect method in the financing. So now we are going to solve this question with 15 marks. Produce a statement of cash flows using indirect method for the presentation. So now this is the overall cash flow of the business. First, you need to see this area, including non-current liability. The company does not have any non-current liability, so you have only to see this area, and you are required to calculate the financing activity of the business. Please do calculate the financing activity of this business. Okay, yes, is it done? So there is an increase in the share capital by so let's do the financing activity. Issue of shares. Issue of shares 400 plus 400. It's 800. And there is no loan notes. I'm talking about dividends. So if the examiner does not give you any hint, yes, it's mentioned here. The company has declared and paid a dividend of 80. The final answer will be 720 net cash flow from the financing activity. Net cash flow from financing activity is 720. Is it clear? And I think you all have got this handout. If not, then you can download the handout with the name Practice Handout Cash Flows from the handout section. And now you are required to solve the finance investing activity for this question. But first read this statement and then solve the investing activity. Yes, for your support, I have break this page. Now you can see the question clearly on the screen. Please do attempt the investing activity. मेरी आवाज आ रही? Okay, so let's do the investing activity. Investing activity, the first thing is purchase of non-current assets. Having an opening balance of 3,000 cost, the closing balance is 3,500. Accumulated depreciation is 2,100 and 2,300. Depreciation expense is 225. So you will get the accumulated depreciation of the disposal account. So please do calculate and give your answers. 2,100 plus 225. The accumulated depreciation will be 25. So this is actually the balancing figure that we have calculated. You can check the calculation. I have added these two figures and deducted this one. To 55 instead of, let me check it, it's 255. Sorry, it's wrong. It's 255. Thank you for the correction. So again, I'm revising the calculation. 2,100 plus 255 minus 2,300. So the value will be 55. I'm talking about the cost account. The opening balance is 3,000. The closing balance is 3,500. There is no revaluation gain, and the disposal figure is 230. The cash paid will be 730. So the purchase of non-current asset will be 730. Sale of non-current asset will be 145. And there is no investment income in this question. So the final figure for the investing activity will be minus 730 plus 145. So the final answer will be 585 negative. Is it clear to all? Is it clear? So we add profit from the sales receipts in investing. We didn't add the profit, it is actually the sale proceeds, 145. The purchase, okay. So let's calculate the profit or loss on disposal. The cost of the asset that we have disposed is 230, having an accumulated depreciation of 55. So the net book value at the time of disposal will be 230 minus 55. The value is 175. So this asset was sold at a value of 145. So there will be a net loss at the time of disposal. So 175 minus, so there is a loss of 30 at the time of disposal. Yes, proceeds from the sale is the value that we have received at the time of the sale of asset. And here this stated that there is a loss. Yeah, there is a loss, but they haven't calculated the figure. So we have to calculate the figure because we can see the full stop here. So the asset was sold for 145 and there's a full stop and it says the loss on this as disposal has been included in the trading expense in this income statement. But we haven't given the value of the loss exactly. So it is one of the requirement to calculate the amount of the loss. Is it clear? Is there any confusions? Okay, is it done? Is it clear now? Okay, wonderful. So now you all need to calculate the operating activity of this question. I'm giving you just 2 minutes to calculate the operating activity. Is it done? Let's start working on the operating activity. Okay, the first thing is you need to have the profit before tax. The profit before tax is not given clearly, so we can start from the net profit, which is 250. Then we add back depreciation expense, which is 255. Then we add back the loss on the disposal, which is 30. Then there is no finance cost, nothing. Okay. Talking about the inventories, inventory. You can see there is an increase in inventory from 825 to 1175. So how much the inventory has increased? Minus 825, the figure is 350. The inventory has increased by 350, but the receivable has decreased by 200, 135. Receivable has decreased, it should be added. And then we move on towards the payables. For the period, the payables has decreased 5075 to 4430. So it will be 645. The decrease in payable should be deducted. It is 645. So then you got the value of the cash flow from operations. So then please do the calculation and calculate the cash flow from operations. So it's 250 plus 255 plus 30 minus 350 plus 135 minus 645. The final answer is negative 325. Wonderful. That is cash flow from operations. Then we take interest paid, which is not yet given here, and tax paid. There is no interest and tax in this question. The net cash flow from the operating activity will be negative 325. So if you wanted to ask anything, please do ask it immediately. Please do ask if you have any confusions. Well, let's move on. Operating activity, investing activity, and financing. So the answer for the operating activity is 325 negative. The answer for the investing activity is 585 negative. And the answer for the financing activity will be 720 positive. Can you calculate it? What will be the net change? So minus 325 minus 585 plus 720. So the net change will be 190. Very good. What about the cash and cash equivalent at start? You have to pick it from the question, which is 2350. Cash and cash equivalent at start is 2350. So the closing value will be cash and cash equivalent at end. So this amount should reconcile with the closing balance of the cash or bank overdraft amount. The closing balance of the cash is 2160. So when you adjust these two figures, the amount should be 2160. So if it is reconciled with the balance sheet value, then it means that we have done the cash flow perfectly, and you will get all the 15 out of 15 marks. I hope it's clear now. Any confusions? Any issues? Any confusion? Do you want to ask anything? Okay. So, okay, related to the proceeds of non-possession. Now, what you wanted to ask, I have a problem related to proceeds. What's the problem? The proceeds of target asset is clearly mentioned in this question. The value is 145. Can you tell me your problem in detail? Okay, let's move on. So right now it's 12:23. We are taking a break of 5 minutes, and we will start at 12:30. So let's take a break. 5 minutes. We'll start at 12:30. If there are carrying amount mentioned instead of the disposal amount, then you write in the CA. CA means, but do remember this point. If you have been given a carrying amount, then you have to prepare the carrying amount account rather than cost account and increment depreciation account separately. And that is the reason examiner has given you the cost of the disposal and you have calculated the accumulated depreciation from the P account. So you haven't been given the carrying amount directly because if it is given in the question, then you have to make the T account for the net book value or carrying amount rather than the cost and the accumulated depreciation separately. I hope it's clear now. Okay, let's take a break and we will start after the break. Okay, welcome back after the break. Now we are going to start the session again. Are you guys are here? Please write yes in the chat box so that we can start the session. Can you see my screen? As per the planner, we are going to start the topic consolidation today. So the today's focus will be on the consolidated balance sheet area. Okay, so Bismillahirrahmanirrahim. So let's start the session. Now, consolidation. Now, what is the meaning of the consolidation? Consolidation means preparation of financial statements of a group. Consolidation means preparation of financial statements of a group. Group means parent and its subsidiaries. Do remember this point, there could be only one parent, there should be only one parent in the group. You cannot have more than one parent company in a group. And we can have as many subsidiaries as we can. So there is no limit on the subsidiary company, but in a group there must be only one parent. Parent company and subsidiary company should work in the same industry or not. So standard says that it is not compulsory that the parent and subsidiary should work in the same industry. They can have a different accounting period, they can have a different accounting policies, they might be in different industries. So there is no requirement according to IFRS that the parent and subsidiary should work in the same industry. Like the parent company it might be an oil company, a subsidiary company is a company who is a car manufacturer. So they both work in different industries. So the parent and the subsidiary can be in different industries. Now, how a parent become a parent and a subsidiary becomes subsidiary? The relationship established when there is a concept of control between the parent and the subsidiary. So when the company A is in a position to control the B company, then you can say that A is a parent and B is a subsidiary. So in order to gain the control, you must have a control on the board of directors of the company, which is the brain of the company. And how you got the majority in the board of directors? Through the voting rights. So usually if you have got more than 50% ordinary shares, then you can say that you have got the majority of votes. And once you have got the majority of the votes, you will be having the majority of seats in the board of directors. And through the majority in the board of directors, this is the only way through which you can control the subsidiary company. So assuming there are total 7 board of directors, out of which 6 related to the company A, then you can say that A is the parent company and B is a subsidiary company. What if the total board of directors is 5 and only 5 directors are related to A? Then is B is a subsidiary company of A? Yes or no? Whether B is a subsidiary company? Yes. Now what about if the situation is 7 out of 4? B is a subsidiary, 7 out of 3, 7 out of 2, 7 out of 1. So in this situation, B is a subsidiary, in this situation, B is a subsidiary, in this situation, B is a subsidiary. Because in all these 3 situations, you have got the majority in the board of directors. But in this situation, now you are not in the majority. Then this situation is called associate company. So these 3 are the examples of the associate company. Is it clear? Now what is the difference? Now, A has got 80% shares in B company and A has got 30% shares in C company. So because you have got the majority of shares, B will be considered as a subsidiary company, and you have got more less than 50% shares, then C will be considered as an associate company. Now what's the difference? Subsidiary and associate. The first requirement for the subsidiary is that you must have a control of the other company. And here you must have significant influence. This is the first difference. Control means that you are going to rule the company. Whatever the policies and the procedures you dictate, everyone should have to follow. But when you have got the significant influence, then it means that you have got only the representation in the board of directors. You are the part of the policy making process, but you are not in a position to control the whole decision making. Like out of 7, if you have got 3 directors, then you cannot control the company. You can only give your suggestions, but the board will decide what to do and what not to do. But once you have got majority of directors, then whatever you guys will say or dictate, the company should have to follow. So in this situation, there is a control, and in the case of associate, there will be a significant. More than 50% shares ordinary. for the subsidiary company and 20% to 50% shares. If you have got 20% to 50% shares, then it is assumed that there is a significant. Now, what to do? Subsidiary should be consolidated according to the standards IFRS 3. And all associates should be sorry, all associates must be accounted for under equity method. This is the accounting treatment under IAS 28. So IAS 28 is specifically for the associate companies and IFRS 3 for the consolidation of subsidiary companies. Is it clear? Is it clear, guys? Okay. Now, I have questions for you. If A company has acquired 30% shares in B company, is it possible in any situation that B will be the subsidiary company of A? Is it possible in any situation that B will be the subsidiary company of A? Yes or no? So the answer is yes, it is possible only in a situation when A has got the control of B company. So in deciding whether B is a subsidiary or not, the most important thing is not the percentage, it is actually the word which is called control. So the word control is more important than the word than percentage. So what does it mean? If the scenario tells you that A company has acquired 30% shares of B company and A has got the power to appoint and remove majority of the board of directors of B company. Just focus on the sentence. A has got the right to appoint or remove majority of the board of directors of B company. Then you must say that A is a parent company and B is a subsidiary. Is it possible in this situation that you have got 90% shares but B is not your subsidiary? Is it possible in any situation that you have got 90% shares but B is not the subsidiary of A? So the answer is a big yes. Yes, it is possible. When You have got 90% shares in B company, but you cannot control because of any reason. When there is no control, then he will not be considered as your subsidiary. Similarly, if the question says that A has got 25% shares in B company, so what is B company? Is it a subsidiary or is it an associate? So if nothing was mentioned, other than this, then you can say B is an associate company. But in order to get the status of associate, there must be a significant influence. So first, you need to see whether you have got a significant influence. Now, what is the meaning of significant influence exactly? Participation in the policy making process. Are in the participation are we are participating in the policy making process? If the answer is yes, then B is your associate. If the answer is no, that you do not have a significant influence despite of acquiring 25% shares, then this is called just simple investment. It will not be considered as an associate if there is no significant influence. So for a subsidiary, the most important thing is control. For an associate, the most important thing is the word significant influence. Do remember this point. Now in this topic, we will be discussing about these three few items. Now these are the basic definitions that we have already discussed. What is group? Significant influence should be of investor into associate. So here's the definition of group: subsidiary, parent, control. Now, this is the definition of a control, and it says that in order to check whether there is a control or not, you have to see the three criteria. If the three criteria are present, then you can say there is a control. If the three criteria are not present at the same time, then you can say there is no control. So what are the 3 points? Power over the investee. First, you need to have a power over the investee. And how we can justify this when we have got the majority of votes? By acquiring more than 50% ordinary share. Second thing is the exposure right to the variable returns. So if you remember my first class of the company accounts, we had discussed that ordinary shareholders will receive a variable dividend and preference shareholders will receive the fixed dividend. So that is the reason you cannot say that preference shareholders can control the subsidiary company. Only the ordinary shareholders, because they got the voting rights and they will receive the variable returns and ability to use the power. And ability to use the power means you must have a solid power, and if you wanted to change anything, you can change. So if the three criteria are met, then you can say we have got the control of the other company. Now, these are the definition of associate, significant influence, and non-controlling interest. Now, this is the important thing that we need to discuss. If A company has acquired 80% shares in B company, with a control, then there must be 20% shares in B company, 20% shares in B company, who will be owned by the other parties, which will be owned by the other parties, but they're not in a position to control the company. Therefore, they are called non-controlling interest. So if you acquired a subsidiary for less than 12 months, then this is called non-controlling interest. Now here is a question for you guys. Please do attempt it and reply answers fast. Now there is a question from the student side. Can you resend the question again? Can you resend the question? Is it clear to all of you? Now what about the answer of this question? So one of the students is asked that if you have got the 40% shares and you have got the control, so yes, this will be considered as a subsidiary company and NCI will be based on 60%. Please send the answer of this question. A, B, C, D. Okay. One of the students saying it's A, someone is saying it's D. So you need to identify which of the following is a subsidiary company. Okay. Now the first thing is the acquisition of the 60% Zacron equity share capital on 1st March. Zacron activities are significantly different. So if the activities are different, you can consolidate the company. So this will be the subsidiary company. First one. So the right answer will be A or D. The offer to acquire 70% of Untitled companies equity share capital on November. The negotiation was finally signed off during January. So this is just an offer. We have not yet acquired the subsidiary till 31st. An acquisition of 45% equity share capital with 3 out of 10 directors. 3 out of 10 directors means it's an associate company. And do remember this associate will be accounted for under equity method. Associates are not consolidated. So the right answer will be A. Is it clear? Okay. The first one is Zacron acquired 60%. Acquisition 60% Zacron shares. That P has acquired 60% shares, and nothing was mentioned, and you can assume that we have got the control of this company, but the activities are significantly different from the group. Like parent company is working in manufacturing industry, or subsidiary is working in subsidiary is working in as a service industry, like airline business, like hospital business. So if the activities are different, so do we need to consolidate? Is it a subsidiary or not? The answer is yes, because it has nothing to do with the business. It's all about the control. If you have got the control, then it means it's a subsidiary. Second one is wrong only because it's just an offer to acquire. So we have not yet acquired the subsidiary company till the year end. Till the year end, Unto is not a subsidiary company of the group. Okay, it's clear. Now you are going to attempt this one. Please do attempt it immediately. Yes, the right answer is D. The right answer is D. Is it clear, guys? So let's move on. A and B. Okay. The question is, which of the following circumstances the investment is not be consolidated? Petri has decided to sell its investment in Alpha as it a loss making. So company has just decided to sell its investment. So we have not yet sold the investment. So it should be consolidated. You cannot exclude a subsidiary only because of the fact that it is a loss making entity. So you cannot exclude that subsidiary. Similarly, in situation of case of B, if the activities of the parent and subsidiaries are different, then you cannot exclude that company just because the activities are different. You have to consolidate both A and B. Similarly, in part C, the standards are different between the parent and subsidiary. So still you need to consolidate even if the standards are different. There is only one situation in which you can exclude that company from being consolidated is when you lost the control. This is the only situation. I hope it's clear now. Now there is a concept of unrealized profit. One of the rule between the parent and subsidiary is for the consolidation is you cannot recognize any of the profit that is being earned by the parent from the subsidiary or from the subsidiary to the parent. You cannot recognize any of the profit. Okay. So if the question says that the parent company has earned some profit from the subsidiary company or the subsidiary company has earned some profit from the parent company, then consolidation does not accept this profit and this profit is named as unrealized profit. So all you need to do is to eliminate that profit from the books. Now what about unrealized profit equation? The simple equation is profit in the original transaction multiplied by percentage of stock still in warehouse. Profit in the transaction multiplied by percentage of the stock still in the warehouse. Okay. So now all of you are required to make the accounting entries when the parent company sold goods to the subsidiary company or the subsidiary company sold goods to the parent company. So all of you are required to make the accounting entry for the unrealized profit. I'm giving you 1 minute. Just write the accounting entries in the chat box. Okay. If the parent company sold goods to the subsidiary company, the accounting entry will be retained earnings debit and stock credit with the amount of unrealized profit. And if the subsidiary company sold goods to the parent company, the accounting entry will be retained earnings and NCI debit and stock credit. The whole of the profit is will be distributed between the parent company, that's the parent share, and NCA, that is the non-controlling interest share. So suppose if the parent company has acquired 80% share in the subsidiary company, so 80% profit will be received by the parent company and 20% of the subsidiary's profit will be distributed to NCA. Is it clear? Now, one of the adjustments in the consolidation is related to the current account. In the current account, it says that if there is some receivable and payable between the parent and subsidiary, it should be eliminated from the group account. So the group accounts does not recognize any intercompany receivables and payables. So it will be considered as a intercompany balance and it must be eliminated from the consolidation. It could be an investment loan, like parent company has given the loan to the subsidiary company. It will also be cancelled. There might be a relationship of interest receivable, interest payable. should also be cancelled. So all you need to do is to remove the intercompany balance from both the parent and subsidiaries books. That is the concept of current account. I hope it's clear. Before we should move forward, I think let's do a practice question first. Now, there is an adjustment for you guys. I want all of you just read this paragraph. Yes. Hmm. Okay, welcome back again. Is my voice is clear? So, hello. Okay. Can you hear my voice? If it's clear now. Okay, thank you. Let's start the session again. Okay, so I gave you this question to solve it for the unrealized profit in which the Wilmslow has acquired 80% shares in the Zeta company. So it says that during the year ended 31st March 2015, Zeta purchased goods. That means parent has sold goods to the subsidiary company. The accounting entry will be retained earnings debit and stock credit, totaling 3,20,000. 1/4 of these goods are still in the inventory. 1/4 of these goods means 1/4. 320 into 1/4 is still in the inventory. 1/4. 320 multiplied by 1 divided by 4. The amount will be 80. Williams Store applies markup on a cost of 25% on all sales. So markup means then you can calculate the unrealized profit by dividing this with 125 multiplied by 25. So here you got the value divided by 125 multiplied by 25. So the accounting entry for the unrealized profit will be 16. So is it clear to all of you? Is this clear? Yes or no? And did you all have joined the WhatsApp group? Did you all have joined the WhatsApp group? I'm sharing my number with you guys again. And in fact, I'm writing my number here. This is my number, but just send a message on the WhatsApp and I will add you on the group. What is 80? 80 is the amount of the sales that is still held in the group accounts, because it is actually saying, suppose if I am going to the next slide, it is actually saying that parent company has sold goods to the subsidiary company with the value of 3,20,000, and subsidiary company has subsequently sold the remaining goods to outside the group. Only 80,000 of these goods is still held in the inventory, and the remaining inventory was sold to outside the group. So amount of the stock that was sold out of the group will be considered as a realized profit for the consolidation, but the amount of the stock which is still unsold will be considered for the calculation of unrealized profit only. So we can only make the unrealized profit accounting entry for the amount to the extent that is still held in the warehouse. So 80,000 is the value of the sales that is still held, and that includes 25% profit. So this is how we have calculated the value of 16 as unrealized profit. I hope it's clear now. Is that clear? Okay, now moving on towards the next points. Now the cost of the investment. Parent company has acquired 80% shares of the subsidiary company. But at what cost? The total amount of the investment that the parent company has made into the subsidiary company will be called as cost of investment. So what do you think should be the accounting entry in the books of the parent company when it acquires shares in the subsidiary? What should be the accounting entry in the books of the parent company when it purchases the shares of subsidiary company? The accounting entry will be debit cost of investment and credit cash. So when the parent company has acquired the shares in the subsidiary company, it makes this accounting entry in the books of accounts. The cost of investment debit and cash credit when the parent company has purchased the shares in the subsidiary company. Is it clear? This is called cash consideration. But parent company can also acquire its shares in the subsidiary company by debiting the cost of investment, and instead of paying the amount consideration in cash, it can issue its own shares. The accounting entry will be share capital and share premium credit. The accounting entry will be share capital and share premium credit. Is it clear? Now, I want all of you to record the transaction. I think pay question. Okay. The next concept is the concept of NCI, non-controlling interest. So in order to calculate the investment of non-controlling interest into the subsidiary, the first thing from FFA point of view or FA point of view, it might be given in the exam question. And second thing is you need to calculate the amount of the NCI from this question. So you need to calculate the amount of the NCI. So how we can calculate the value of NCI? Suppose parent company has acquired 80% shares of subsidiary company, then definitely 20% shares will be acquired by the NCI group. So you need to calculate the number of shares of NCI, number of NCI shares into share price. So this is the formula for the calculation of NCI at acquisition. So I request all of you, these are 9,000 shares. To do this question, Zenda, and calculate the value of NCI. Attempt this question and calculate the value of NCI. Zenda acquired 5,400 shares out of 9,000 shares in Meta. So what is the percentage of shares that Zenda has acquired? 5,400 divided by 9,000. So Zenda has acquired 5,400 shares out of 9,000 shares. That means Zenda has acquired 60% shares of Meta. So definitely remaining 40% shares will be acquired by NCI Group. So how many shares does the NCI Group must have? Because out of 9,000 shares, 5,000 shares was acquired, 5,400 shares were acquired by the, very good. The answer is 3,600. The 3,600 shares was acquired by the NCI Group. And the price of each share of Meta is 1.5. So this is how we calculate the value of the NCI acquisition. So the amount will be 5,400. Very good. Very good. Okay, so we have covered the concept of unrealized profit up till now, current accounts, cost of investments, NCI acquisition, Now there are a few important points for consolidation purpose. All the assets and liabilities of the subsidiary should be measured at the fair value at acquisition. Do remember this point? When we are doing the consolidation, all the assets and liabilities of the subsidiary companies should be measured at the fair value at the date of acquisition. All intangible assets should be recognized for the purpose of consolidation, and all contingent liabilities must be recognized. Consolidation should be on the basis of control. Like if you have got the control, everything is yours, not on the basis of ownership. What does it mean? If the parent has acquired 80% shares of subsidiary company, non-current assets of parent is 10, non-current assets of subsidiary is 10. So when we make the group accounts, we have to add total to the value of 20. But with reference to the ownership, we have got a stake of 80% in the subsidiary. So if you take the 80% figure of this amount, it will be 8 plus 10. So the amount will be 18 with reference to the ownership. But we never do consolidation based on the ownership. We only do the consolidation based on the control. Once you got the control, you have to add the full amount. The assets and liabilities will be consolidated 100%. So that is the reason it says that similar items should be merged 100%. But if there is some intercompany balances, it should be cancelled. If there are some current account balances, then it must be cancelled. Current account means intercompany receivables and payables. Okay. With reference to the contingent liabilities, according to IS 37, it says that the contingent liabilities must be disclosed in notes to the accounts. So we never make the accounting entries for the contingent liabilities. It must be disclosed in notes to the accounts. But for the purpose of consolidation, we have to record this contingent liability, means you have to make the provision. If you are not getting this point, we will discuss this point when we are discussing the topic IS 37. Fair valuation. We do the fair valuation adjustments in the books of subsidiary company only because IFRS 3 says that whenever you are going to do the consolidation, first make sure that all the assets and the liabilities of the subsidiary company should be measured at the fair value at the date of acquisition. So the accounting entry will be asset debit and revaluation reserve credit. Like suppose at the date of acquisition, one of the non-current asset has a book value of 10 but has a fair value of 50. So according to IFRS 3, at the date of acquisition, it should be measured at 50, not 10. So you need to do an adjustment of 40, which is called revaluation. So the accounting entry will be asset debit by 40 and revaluation reserve credit by 40. I hope it's clear now. Now, for the purpose of calculating goodwill, the first thing you need should be the cost of investment. Then you have to add NCA at acquisition in it. and we have already discussed these two figures. Then the last thing you need is the fair value of net assets at acquisition. And for this, you need to follow this format. So how I can calculate the fair value of net assets at acquisition of subsidiary company? All I should need to do is to add the share capital figure only for the subsidiary. It's only about the subsidiary company. Share capital, share premium, retained earnings, other reserves, and fair valuation. When we add all these factors, we got the value of fair value of net assets at acquisition. But do remember at this point that whenever we are preparing the net assets at acquisition, we need the retained earnings of the subsidiary at the date of acquisition. We need the retained earnings of subsidiary company at the date of acquisition. This is how we calculate the net assets. So talking about the asset side, of the group accounts, all the property, plant and equipments should be added for both the parent and subsidiary, and if there is a revaluation, it must be added or deducted. Upward revaluation will be added, downward revaluation will be deducted from them. Then we calculate the goodwill through the cost of investment based on this formula according to IFRS 3. Then for the current assets, you need to add stock, parent plus subsidiary minus unrealized profit. Then we have receivables, parent plus subsidiary minus current account adjustments. And finally, cash or bank. I don't have the place over there, so I'm writing here. Cash and bank will be parent and subsidiary only. So this is how we prepare the asset side of the consolidated balance sheet. So the basic concept is the similar item should be merged for both the parent and subsidiary company, and intercompany profits and intercompany balances should be eliminated. Goodwill will be calculated based on the formula mentioned here. So now I'm giving you the question. All of you are required to solve the asset side of this question. There is a question for you on the last slide. Now this is the question for you guys. All of you are required to calculate the asset side only of this question. I'm giving you 3 minutes. Okay, so let's solve this question. From the group's perspective, you only need to add the property, plant, and equipment of parent and subsidiary. So the property, plant, and equipment of parent company is 23 and subsidiary company is 13,000. So it will be 36,000. And as we don't have any revaluation or fair valuation adjustment, therefore the property, plant, and equipment figure will be 36,000. Now for current assets, we don't have any unrealized profit adjustment or intercompany balance adjustment. So simply we need to add these two figures. So 8,500 plus 3,200, it will become 11,700. And finally, we have got the investment figure. This investment figure will be used to calculate the goodwill. Which should be reported here. Then we got the value of total net assets. So I have some space here. I'm calculating the goodwill here. Cost of investment is 19,000. NCR acquisition is given here already. It's 2 million. 2 million means 2,000. So the total investment will be 21,000. Fair value of net assets. Now you need to add these figures of the subsidiary company. But do remember this, that we need a retained earnings at the date of acquisition. This retained earnings is mentioned here at 31st March 2007. But we have acquired the subsidiary company on 1st April 2006. So at that date, we need a retained earnings which is mentioned here. It is 3 million. So the total net assets at the date of acquisition will be 13,000. So the goodwill amount will be 21 minus 13. So it is 8,000 that should be reported here. So 36,000 plus 8,000 plus 11,700. The total assets of the business will be 55,700. So these are the total assets. Here we have added the value of share capital and retained earnings both. Share capital is 10,000 and retained earnings is 3,000. Therefore, it will become 13,000 as a fair value of net assets. So is it clear to all of you? Is it clear? Fair value of net assets will be the combination of share capital plus share premium plus revaluation reserve plus retained earnings. Share capital of the subsidiary company is 10,000 here. We don't have any share premium, we don't have any revaluation, and the retained earnings at acquisition is 3,000. So this is how we calculated the fair value of net assets. So that's the end of the session for today. Tomorrow we will be discussing about the equity and the liability side of the consolidated balance sheet along with the consolidated income statement, and we will be focusing on the topic ratio analysis. So tomorrow is our day 4 in fact, and we will discuss the concept of consolidation. And so I want your feedback, that what's your feeling about the topics that we have already covered, that is company account and cash flow. So did you people got the benefit from the practice to pass session, and did it improve your concepts of company accounts and cash flows? We haven't done yet the topic of consolidation. So tomorrow you all will be in a position to have a sound grip on the topic consolidation. Tomorrow. You have to wait till tomorrow. Tomorrow you will be in a position to have a sound grip on this topic. So I request all of you to practice as much as you can for the topic company accounts and cash flow, and you don't need to worry about the consolidation topic. We will discuss this topic in more detail tomorrow, and the next focus will be on the ratios topic. Thank you very much for today's session, and we will work on consolidation and ratios in tomorrow. And if you have any confusion, you can ask it on the WhatsApp group, and try to share your answers of the assignments of the WhatsApp group. And do remember this, I will share a mock examination on Saturday, and be prepared yourself for the mock examination. So take care. Allah Hafiz.